All right, so anyone following the markets knows that WPIL Limited just had their Q2.
Results.
Yeah, their Q2 for fiscal year 2025. And
Good quarter.
it is a big quarter, a lot going on. So if you want to know what's happening with this company, well, you've come to the right place because we're going to break down those numbers and see what's happening with WPIL.
Yeah, this company's been around
Forever.
Yeah, since 1952. So they've seen a lot. They've done a lot. And they started off in pumps and pumping systems. But it's really interesting to see how their business has kind of shifted.
Yeah.
Evolved.
And if we're talking about their Q2 revenue, I mean, 491 crore rupees.
Huge.
That's a big jump.
Passive jump, yeah.
From their previous quarter.
Yeah, and if you compare it to the same quarter last year, we're talking about 50% increase. This is serious growth.
Wow. And so when you see that kind of growth, obviously the next thing you want to know.
Is it profitable?
Exactly.
Right.
What's their profitability look like? I mean,
what's the bottom line?
Exactly. So for Q2, their EBITDA came in at 104 crore rupees, which gives them an EBITDA margin of 21%.
Which is
a significant
improvement
from last quarter. Yeah. So their profitability is definitely keeping pace with this massive growth.
It is. And that EBITDA margin of 21%, that's healthy. It speaks to the company's focus on these high margin projects.
Well, that's what's interesting, right? That this company, their project segment is really starting to dominate their revenue. I mean, that's where they're seeing a lot of this growth.
Over half of their revenue now.
Exactly. So profit after tax, their PAT for Q2, 70 crore rupees.
Not bad.
Again, a substantial increase compared to the last quarter.
And their previous quarter.
Yeah. So it seems like they're doing really well. But are there any red flags that we need to be aware of?
Well, one thing that kind of jumps out is their trade receivables.
Oh, boy.
Which stands at 160 days. So that's how long it takes them to collect payments from their customers.
160 days.
On average, 160 days.
Wow.
That's a long time.
That's a long time to wait to get paid.
It is, especially for a company that's increasingly involved in large-scale projects.
Right.
Right, because those often involve complex payment schedules, and that can lead to these kind of delays.
Right. I mean, that's going to obviously have a big impact on their free cash flow, right?
Oh, absolutely.
If you're not getting paid for 160 days.
Yeah. Speaking of free cash flow, their free cash flow, or FCF, was negative 90 crore rupees for the full fiscal year 2024.
Negative.
A negative.
So they're not really making any money.
Well, they're making money, but they're not generating positive cash flow.
Right. Where is all the cash going?
Yeah, it's probably a combination of things. We talked about those high debtor days. That's definitely playing a role. And as they ramp up their projects segment, they're probably investing heavily in new equipment and infrastructure. And that can definitely impact your free cash flow in the short term.
So they're making money, but they don't really have any money.
Yeah. It sounds strange, but their profitability looks great on paper. But their ability to convert that profit into actual cash, it's lagging.
Yeah. So I think to really get to the bottom of this, we need to look at some financial ratios.
Yeah, let's take a deeper dive into those and see if they can shed some light on this situation.
Yeah. Okay, so let's talk about some of these financial ratios.
Yeah.
And see what they tell us about WPIL. Starting with the price to earnings ratio, the PE ratio.
Yeah. Currently at 27.7.
Which basically means that investors are willing to pay 27.7 rupees for every 1 rupee of WPIL's earnings.
That's right.
So is that high? Is that low? What does that tell us?
Well, it's a little bit above the average for the industry.
Okay.
So it suggests that investors are pretty confident in WPIL's future growth.
They think they're going to continue to grow.
But we need to consider other factors to see if that's really justified.
Exactly.
So let's look at the debt-to-equity ratio, which currently sits at 0.8.
Okay, so for every 1 rupee of equity, they have 0.8 rupees of debt.
That's right.
So that's not insignificant.
It's not dangerously high, but it's something to keep in mind.
Yeah. Is that contributing to their free cash flow problems?
It could be a factor.
Okay.
Because they're using debt to finance this expansion.
Right.
Which can be a good strategy if those investments generate strong returns, but it also means they have these interest payments.
Of course.
That they have to keep up with. And speaking of interest payments, the interest coverage ratio.
Yeah. How are they covering their interest?
It's at a very healthy 8.3.
Wow. So they're doing pretty well.
Yeah.
At covering their interest expenses.
They're generating more than enough operating income to cover that debt.
Okay. What about their price-to-sales ratio?
All right, so the price-to-sales ratio sits at 2.2 right now. And what that tells us is that investors are valuing WPIL at 2.2 rupees for every 1 rupee of sales.
Okay.
Again, slightly above the industry average. So again,
So they think there's a lot of potential.
yeah, there's positive sentiment around the company.
Okay. What about EV to EBITDA?
All right, so EV to EBITDA takes into account the company's debt.
It gives us the big picture.
Yeah, the whole picture.
Yeah.
And that's currently sitting at 16.8.
And is that good?
It's a little on the high side compared to other similar companies in the infrastructure space.
Okay.
It indicates that WPIL is being valued at a premium.
Yeah, people really like this company.
They do. They're optimistic.
But, you know, it's interesting because we're seeing all this positive sentiment with their ratios.
Yeah.
But I keep thinking back to that negative free cash flow.
Right.
What are some ratios that can shed some light on that?
Well, one ratio that can help us there is the PACI to CFO ratio,
Okay.
which compares their profit after tax to their cash flow from operations.
Right.
And that currently stands at 1.2.
Okay, so for every 1 rupee of profit they're reporting, they're generating 1.2 rupees in cash flow from operations.
Yeah, that's right.
But isn't that good?
Well, it's a positive sign.
Like,
it
yeah.
means that their profits aren't just an accounting illusion. They're actually generating real cash. However, this ratio doesn't capture their capital expenditures, which are likely significant given all this expansion.
Right, they're buying equipment, they're investing in infrastructure,
Exactly.
which costs money.
And that's probably eating into their free cash flow, even though those core operations are generating positive cash.
Yeah, so it's kind of like they're spending money to make money, but
Yeah.
they're not quite there yet.
It's a balancing act.
Yeah. What about their overall profitability? Like, how are they using their resources to make money? What can we tell from the ratios about that?
Sure. So let's take a look at their return on capital employed,
Right.
ROCE, which is sitting at a very respectable 20.4%,
Okay.
which means that they're generating good returns on the capital that's invested in the business.
Right.
Now their return on equity, or ROE, is even more impressive.
Let's hear it.
46.2%,
Wow.
which is a fantastic return for shareholders.
That's very good.
Yeah, so they're doing a lot of things right.
That's really good. What's driving that?
Well, it's a few things. Their profit margins are strong. They're using leverage effectively to amplify those returns. And then there's the asset turnover ratio,
Okay.
which is currently at 1.1.
So that's telling us how well they're using their assets to generate revenue.
Exactly.
So 1.1 basically means for every 1 rupee of assets, they're generating 1.1 rupees in sales.
That's right.
Is that good?
It's reasonable for their industry. It shows they're not sitting on a bunch of idle assets.
Okay.
But there might be some room for improvement there. Maybe they can optimize their inventory management or speed up their collection cycle
Right.
and squeeze a bit more revenue out of their existing asset base.
I mean, it's interesting because we've looked at a lot of ratios and they seem to be performing well in a lot of areas.
Yeah.
But those high debtor days
Yeah.
and that negative free cash flow
Right.
is concerning. It's like we're looking at 2 different companies.
Yeah.
On the one hand, really profitable, great returns.
Investors love them.
Investors love them. But then on the other hand,
Can't generate cash.
negative free cash flow, huge debtor days.
Yeah, it's a classic growth story. They're putting a lot of money back into the business, investing heavily to fuel that growth.
Yeah.
And it's working. They're seeing the top line growth and the profitability, but it comes at a cost.
Yeah. There's
And that cost is the cash flow.
making any money.
Right.
So the question is, can they keep this up?
That's the big question. Can they sustain this level of performance if they can't figure out the cash flow situation? And I think the answer really hinges on their ability to manage their working capital.
Yeah.
They got to find a way to speed up collections, maybe negotiate better payment terms with their customers. And they really need to carefully balance their growth ambitions with the reality of their cash flow.
It's a tough situation to be in,
It is.
especially because they're so focused on this project segment,
Yeah.
which, you know, these large-scale projects, they could be really profitable,
Lucrative.
but they take a long time to get paid.
Yeah, it's a double-edged sword. It's driving their profitability, but it's also putting a huge strain on that working capital. So they really have to figure out how to manage that tension.
So what do you think? Is this a company that's worth investing in, or are the risks just too big?
I think it's too early to say, for sure. There's a lot to like about WPIL, their profitability, their market position, but those red flags are definitely there. So I think we need to see what happens over the next few quarters.
Yeah.
If they can start to improve their working capital management
Show us the cash.
and generate some positive free cash flow, that'll be a really strong signal.
Yeah. So we'll wait and see what happens.
Absolutely. And remember, this is just one snapshot in time. Companies evolve, they adapt, And it'll be interesting to see how WPIL navigates these challenges.
Well, this has been a really fascinating look at WPIL.
Yeah, it's been fun.
It's a company that I think a lot of people are watching.
They are.
So it's great to be able to unpack these numbers and see what's really going on.
Absolutely. And I think it highlights how important it is to look beyond just the surface level numbers.
Yeah.
And really dig into the details to understand a company's true financial health.
Yeah, absolutely. Well, thanks for joining us for this deep dive into WPIL. We hope you learned something. And to all our listeners out there, keep learning, keep exploring, and we'll catch you on our next deep dive.